Okay, good morning, everyone. So today we're gonna do this BS 251 midterm exam review session, and I'm gonna share my screen. I will do the questions and review the concept with you all together one by one. So yeah, let's get started. Today, we're gonna talk about financial statement, some basics about financial statement from chapter one and chapter two, and I will cover some of the concept about accrued accounting concept for chapter two and chapter three, and then we will do revenue recognition. And then we will cover something about internal control and cash for chapter six, and also account receivable for chapter six, and then inventory. And finally, I will give some general advices for the midterm review, for midterm exam. Right. So first of all, let's move to the basics. Right. So when we talk about financial statements, there are two most fundamental equations of financial accounting that we are frequently using. That is, I think everyone should be comfortable with this. Assets equals to liability plus shareholders' equity. And this is the first fundamental rule. So assets equals to liability plus shareholders' equity. And second one will be debit equals to credit. And also, this is the fundamental rule when we're making the journal entries. Make sure that um, like you always start with something that you are familiar with. Always start something with some accounts like cash because cash is more easy to identify the movement, right? You debit cash and then it means your cash goes up, and the other side, if your assets goes up, then probably another asset goes down, or your liability or shareholders' equity will goes up. So every time when you do the journal entries, make sure that the left side still equals to the right side for this equation. And also make sure that you do both debit and credit, and make sure this debit and credit amount will equals to each other. So secondly, let's talk about assets. So assets is something, some resource controlled by an entity, and it is result of past events. It has future benefit and values. And some examples could be cash, account receivable, and also, for example, equipment or lands or some other assets. And these are the widely seen assets accounts. And when we talk about liability, liability present the obligation of the company. Similarly, like the assets is also the result of past events, and it's the settlements involved an outflow of resources, which means the more liability you have as a company, and the more resources that you have to give out to others in the future. For example, account receivable is typically liability, account payable, sorry, account payable, and also bonds payable, bond payable, and notes payables, notes payable, interest payable, something like this, something payable will be the liabilities. Okay, next one, let's move to the shareholders' equity. So shareholders' equity means the difference. Exactly, that's how it was calculated. It's the difference between total assets and total liability. And some examples could be preferred shares, common shares, and also retained earnings. So preferred shares, common shares, retained earnings will be the examples of shareholders' equity. Um, so whenever we encounter this kind of accounts, we need to know what kind of categories they belong to, so that we will use the debit and credit correctly. And next thing, so that's the moment when we use debit or credit. That's why we have to say. We have to know the category of this accounts, right? So when we debit an assets, the total assets will goes up, and when we credit assets, the total assets will goes down. And the liability will be the opposite direction. When we debit a liability, the total liability will goes down. And when we credit a liability, the total liability will goes up. And let's move to the question one. So is it an assets liability or shareholders equity account? So when we see cash, um, it will be assets because cash is the commonly assets. You should get very comfortable with this. And second one, the common shares will be shareholders equity. And retained earnings will be shareholders' equity and prepaid expenses. So when you say expenses, it's always expense, but this prepaid expenses is something that you're prepaid, something that you paid in advance, but and you haven't enjoyed the service yet. So it's assets because according to the definition of assets, is some resources controlled by you because you paid them in advance already, and it has future benefit value. This prepaid expenses will bring you future benefit. And next one, income tax payable. So whenever we see something like payable, it goes to liability. And goodwill is assets. And next one, advertising expenses. So this one is a bit tricky here because this is expense. So it is an expense. It affects the return earnings, but it is not a direct shareholders' equity account. At the end of the day, it will affect the shareholders' equity, but it is an expense. It doesn't belong to any of this category. It's not assets, it's not liability, and it's not shareholders equity. It is expense. Okay. All right, let's move to the next part. We're gonna talk about the four types of financial statement. First one, um, balance sheet. And balance sheet is also called statement of financial position. Um, and still, we're going to use the fundamental equation because, as you can see it here, we will place the assets on the left side and liability and shareholders' equity on the right side. So assets equals to liability plus shareholders' equity. And for the left part, assets actually divided, um, will be split into two parts, like current assets and non-current assets. And current assets will typically be something like cash, account receivable, inventory, prepaid expenses. These items are very easy to get liquidated, and this will be listed on the top. And for something like buildings, sorry, for something like buildings, equipment, um, and also inventory, this belongs to the category of non-current assets. It's something that won't realize the value in a year. It's not that easy to get liquidated. It's not that easy to convert them to cash. So it belongs to non-current assets. And we will sum up the current assets and non-current assets, and we have the total assets here at the end of the left side. And for the right side, we have liabilities. And these liabilities will also be divided into two parts, current liability and non-current liability. So the current liability is the liability that will due within a year. And non-current liability is some liability that is not due, is due more than a year, right? Um, and shareholders' equity, we have common shares and retained earnings here. And be aware that retained earnings also appears here in shareholders' equity. And then we sum up the total liability and shareholders' equity on the right side. So make sure at the end of the day, this total assets has to equal the total liability and shareholders' equity, or otherwise you made a mistake. And next thing, let's talk about income statement. And this income statement is also called statement of comprehensive income. And the fundamental equations that we will use for this income statement is the revenue subtract expense equals to net income. And similarly, like the balance sheet, we put the name of the company here and the year. And we put for the year end, December 31, 2024, put the date of the year here, the date of the end of the year here. Um, and at the beginning, we put the revenue here, which is sales revenue or some other kinds of revenue, and then we have the total revenue. And then we put the cost of goods sold here. You can find in some of the other net income, st the income statement, you can find the gross margin, which is um, the total revenue subtract the COGS, and then it has the gross margin, but you don't have to put the gross margin here unless you are required to do so. So for this um, income statement, you can just write like this way. Put the revenues here and total revenue and all the expense, list all the expenses here and sum them up to have the total expenses. And then we use the revenues to subtract the expenses, and then we have the net income. Okay. And next one will be statement of changes in equity. So apart from income statement and also balance sheet, we have the statement of changes in equity. And a part of this statement is the returned earnings. And when we do a balance sheet, we have to explain where the ending returned earnings come from, right? So we use the beginning returned earnings and plus net income and subtract dividends. So this net income could be positive and it also could be negative. Depends on whether this company is at loss or is making some profit. And this dividend will be subtracted if any. It means if this company give out the dividend and then you have to subtract it here. So the beginning return earning plus net income, subtract dividend, you will have the ending return earnings. And next thing is statement of cash flows, also called cash flow, cash flow statement. And the cash flow statement presents the cash flow from operating, investing, and financing activities. And these are the three types of activities activities for cash flow statement. And for operating, it means day-to-day business activities. For example, collection of account receivables, um, getting money from the customer, something like this. And investing activities means purchasing or selling of assets. For example, if you sell your equipment, if you sell your lands, it will be or in another way, if you purchase some new equipment, purchase some new lands, it will also fall into the category of investing cash flow activity. And for financing activity, it basically means that you are financing from the market. You are using debt or you are paying out the debt, or if you are issuing stocks to finance yourself from the market, and these activities will be financing. Okay, so next question, how are the balance sheet, income statement, and statement of return earnings connected? So the balance sheet, income statement, and statement of return earnings are connected through the following accounts. Balance sheet, return earnings. Remember that a return earnings is listed in shareholders' equity, and also return earnings will be reflected in the statement of return earnings. So that's how it was connected. And also income statement. In the income statement, we have net income. We have net income. The net income is actually appeared here, but this net income will also um, be a component that we calculate the return earnings, right? So we have return earnings here, we have net income here, and net income is a part of the income statement, and return earnings is a part of the balance sheet. And this this is how the new return earnings are calculated. So that's how these three statement are connected. Yeah, let's move to the next question. So let's read this all together. The stock market sells stocks to finance students at BIDI. The controller is extremely disorganized and cannot find the entirety of the financial information. However, they know that their assets and liability are correct. On December 31, the controller report 20,000 in equipment, 10,000 in bonds payables, 15,000 in patent, and 1,000 in salary expenses. So how much will the stock market have in shareholders' equity on their balance sheet? So the question is talking about balance sheet. Then it means that we have to use the fundamental equation of assets equals to um, liabilities plus equity. Right? So we put the equation here as a hint and reminder for us. And for assets, what do we have? We have um this is the equipment. So we have the equipment this much, 20,000. Oh, we don't not use this mark. It's quite confusing. 20,000. And what else we have? We have patents, 15,000. I guess I guess that's all. So for assets we have 35,000. And for liabilities, um, what do we have? We have bonds payables. We have bonds payable, which is 10,000. And yeah, that's everything. So 10,000. And shareholders' equity. So this question didn't give us any extra information about shareholders' equity, but we can just use this equation to calculate shareholders' equity. We just subtract 10,000 from the 35,000 because um, you know, equity equals to assets subtract the liabilities, right? So for shareholders' equity, we have 25,000. And this is very simple, and it is how this shareholders' equity is calculated. And for this one, 1,000 in salary expenses. So this is the expense accounts, and this 1,000 expense is included in the calculation in retained earnings of shareholders' equity. So we will not use this 1,000 in salary expenses here. We will simply get the answer from assets subtract liability. Don't be confused. Don't get confused here. Okay, let's move to the second part, accrual accounting concept, the three golden rules of journal entry. So first of all, again, debit equals to credit. And we always debit expenses and we always credit revenues. So we always debit expenses to show that expenses is going up, and ultimately it will affect your returned earnings, and it will make the revenue and the returned earnings goes down. And we credit revenues to show that our revenues goes up, and it will increase our revenues, and at the end of the day, it will increase the return earnings. So, but we have exceptions for this always debit expenses and always credit revenues. If we are doing and correcting or in other words adjusting entry, or if we are doing the closing entry, then we will do the opposite. We will credit expenses and we will debit revenues. And for these closing entries, we will do this because we are trying to clear out the revenue and expenses, and we will put this into income summaries. That's how we do the closing entries. And let's have a look at the question number 4. So the merchant of tennis is a sport shop in Shakespearean times. After discussion with their auditors, they discovered that several adjusting and correcting entries are still required. And what we require to do, please make the year-end adjusting entries required for December 31, 2024. The merchant of tennis is counting on you to be audit you can be. Okay, so the merchant of tennis purchased a 2-year insurance policy on July 1st, 2023. So this information is useful. It's the right middle of the year. And on this date, it debit insurance expense by 40,000 and credit cash. So I think this is not the correct move because standing on the point of that day, so this insurance expenses, so it's not this insurance should be in the prepaid expenses because they paid for the following 2 years, and this 2 years of insurance has not happens has not happened yet. So it is not expense. Expense is something that already happens. You already enjoy the service, or you already spent your money out, and this is expense. So this is the mistake. And in order to correct the mistake, first of all, we have to do a reversed entry. So normally when we have well, as said, it debit insurance expense by 40,000, and then we will do the opposite, right? The credit insurance expense, and we debit cash. Because the journal entry that we used to make the wrong one will be with debit insurance and credit cash. So we are trying to do a reverse one. We debit 40,000, credit 40,000. Okay, so after this adjusting journal entry, everything goes back to the original point. And then we will do the right entry. We debit, and this time we will use the correct account, which is prepaid insurance. or you can put prepaid expenses here. It doesn't matter. And this time we're doing the right thing. Oh, sorry. And we put 40,000. We debit prepaid insurance. We are debiting the assets to show that our assets is going up, and we will credit cash because we are paying the money out, and we put 40,000 here. And this is the right journal entry. And we are also required to make the year-end adjusting journal entries required for December 31, 2024. So December 31, 2024, it will be the end of 2024. And this is the middle of 2023. So 1.5 years has passed um, when we have to do the like adjusting journal entry. So we will move this part from prepaid insurance to the real insurance expense. So we will debit insurance expense and we will credit prepaid insurance. And amount will be because previous we have 40,000 in the prepaid insurance and 1.5 years has passed when we have to do this adjusting journal entry. Um, we paid for 2 years and 1.5 years has passed, right? So we use this number to times 40, and this means years, 2 years. And 40 is come from here. And this is the amount that previously existed in prepaid insurance. So in this way, it will be 30,000. And the prepaid insurance will decrease by 30,000. And actually, this 30,000 is moving from the prepaid insurance to the real expense. So we are using this amount. We used this amount. Or in another word, you can combine this together because we have prepaid insurance here, right? And we also have prepaid insurance here. And we have debit cash here and credit cash here. So altogether, if we combine altogether, we can have debit prepaid insurance and credit insurance expense. Credit insurance expense. And this is 1,000, 10,000, and this is 10,000. Yeah. So this yellow part This yellow part is the combined entries. And you can write step by steps, or you can write combined entries if you are able to. Or both of these are correct. Okay. So that's about the first part. So at the end of the year, staff report 2,000 of supply inventory on the balance sheet. However, a detailed account by the auditors produced only 1,100 of supplies. So what is the error? The error will be, actually this is no error. It's just an adjusting entries required. So we haven't booked anything wrongly. It's just perhaps that they used up some of the um, material or the supplies, and we haven't booked this yet because we have to believe the detailed count by the auditors in the end, right? So it means we only have 1,100 of supplies left, and there's 900 usage that we haven't booked or is not reflected on the general ledger. So that's the adjusting entry that we have to make. So what we will do, we will debit supply expense, and we put 900 here, 900, and credit supplies inventory. And in exam, you can also just to put inventory here, or like inventory dash um supplies, or inventory bracket supplies. It's all no problem. Okay, so let's move to the next question. The company recorded a collection of 20,000 from its suppliers by debiting cash and crediting account payable. So this is wrong, right? Because you are collecting the money or the cash from your suppliers, but you use account payable. You should use account receivable. You should debit cash and credit account receivable. So the error is should have, so we should have debit cash and credit account receivable. So similarly, like the previous one, first of all, we will do a reverse entry, like do entries to make it goes back to the original point. We will debit accounts payable and the amount will be 20,000. And this is for reverse purpose. And we create cash. And after doing this reversed entry, we will do the correct entry. So we will debit cash and we will credit account payable. And this is the correct scene. Okay, so something like this. And the amount is still the same because we are collecting money, right? So we will debit cash to show that cash goes up and credit receivable. My bad. Account receivable. CIVA. I hope I spelled the right account receivable. Yeah. So we will credit account receivable to show that our another asset goes down, and this one asset goes down, and one asset goes up. The value is transferring within the assets, within the left side of the equation. And and also you can combine all these two together. So in this way, this the only things that is left will be debit account payable and credit account receivable. And 20,000 here and 20,000 here because this credit cash and debit cash will be offsetted, right? This one will be offset. So this is the only thing that is left. So the yellow one is the combined entries. Then you can write in this way or you can write in the combined way. It's okay. Next part, let's move to the revenue recognition. So about the revenue recognition criteria and the efforts to 15, there are five steps to do the revenue recognition. First of all, you have to identify the contract with the client or the customer, which means you have to be able to identify the seller, the buyer, the terms, and also their pricing. And secondly, you need to identify the performance obligation in the contract. What typically what is the service and what is the good to be provided and delivered. And next one, determine the transaction price, and it's always stated in the contract. And the fourth thing, allocate the transaction price to the performance obligations in the contract. And the service and goods to be provided. And always it's like it will be allocated based on the standalone prices. Okay. So yeah, the last one, recognized revenue when or as the company satisfy the performance obligations. And this is the last step. For question 5, let's read this all together. So this Springston company produced industrial lawnmowers for arenas and stadiums in the Lower Mainland. On July 1st, 2024, they struck a deal with Stadium X to manufacture four industry machines for a total price that will be within the range of 1 million and 1.5, 1.4 million, depends on the market rate at the time of delivery. And this Stadium X paid a deposit of 200,000 on July 1st and will pay the remainder upon completion of the contract. The total cost to manufacture all these four machines are 500,000. On December 31, two lawn mowers were finished and delivered to Stadium X, and we are required to prepare the two journal entries this company would record on December 31, 2024. So the date will be useful. I highlight the date here, and this is the middle of the year. Four industry lawn mowers and two lawn mowers were finished and delivered. It's half, which is 50%. And this is a deposit July the 1st. And this is the cost. Wow. So these are the information, all the key information that we have. So thinking about it, standing on the point of July 1st, the Stadium X paid the company a deposit of 200,000. So when the company accept the deposit, it will be debit cash, 300,000. And deposit is always goes into deferred revenue because this is for GE July. And this is the GE for July 1st, 2024, when we initially get the deposit, and this is how we book this. Right. So why we put this into deferred revenue? Because we simply get the deposit, we have the money, but we haven't fulfilled our obligation. We haven't do anything for the company, the other side yet. So we have to put this as a part of the liability. So deferred revenue is a part of the liability. It means that in the future we have to do something, right? So on July 1st, we have a journal entry like this. And we have also have to prepare the two journal entries that this company will record on December 31. So on December 31, two lawn mowers were finished and delivered to Stadium X. So by reading this, we know in the contract, we have to deliver four equipment, four machines, and two has been finished and delivered. So we can book or recognize half of the revenue. So we will credit revenue and we always credit revenue, right? So it has to be this credit side. So how it was calculated? We will choose this figure because we are sorry, this is blue. We will choose this figure because we are accountant, we have to be prudent. we have to be careful about the number that we use, right? So we will choose the smaller, we will choose the smaller figure. So we use 1 million to times two lawnmowers were finished. And in the contract, we have four, right? And this 1 million is the price for four. And this is how it was calculated. So it will be 500,000. Okay. So we put 500,000 here as the revenue. And like this 200,000 was already put into the deferred revenue. And this time we have to transfer this part from the deferred revenue to the real revenue. And we will debit, sorry, we will debit deferred revenue, which is 30,000, 200,000, right? Because we only have deferred revenue for this 200,000. It's all the value that we received as deposit and we put into deferred revenue. And we still have some parts left. So even though we don't know what is the account that we will use to put the figure here, right? So the question didn't say anything about the the account that we may probably use. So normally we will put cash or account receivable here, AR. But it depends on the situation. If it says that we already get the cash, then we will use the cash. If something appears like on account or is not mentioned, we will use account receivable. So by reading this again, so it is said this Stadium X has deposit of 200,000 on July 1st and will pay the remainder upon completion of the contract. So the Stadium X has not paid us yet. So the Stadium X will only pay us when we complete the contract. Right now, we only complete half of the contract. So we will not use cash. We will use account receivable. Okay. Account receivable here. Yeah, so that's the journal entries for the revenue part. And also don't forget every time when you make a revenue, you have to book the COGS, right? And the other side normally will be credit inventory. So what is the COGS? The COGS can be found here. The total cost to manufacture all four machines are 500,000. So that's tricky because we are not using the total 500,000 because we only delivered or complete uh, two out of the four of the equipments, and we put 205 250,000 here, and here 250,000. Yeah, that's the journal entries that we have to make on December 31. And I put the journal entries that we will do on July 1st, 2024 here as a hint and reminder for what to do for the year-end journal entries. So we only have to do this part. Okay, so let's move to the next part. The sales discount. So when we see something like this, it's 2 means 20% discount. If you pay within 10 days, you will have 2% discount, right? And net 30 means the balance is due in 30 days. And this is quite simple. Percentage, and this is the day that you pay to enjoy the percentage of discount. And this is the due date. So the journal entry when item is sold. Whenever we sell something, we have to credit sales revenue. We are trying to recognize the revenue. And if we didn't receive the money yet, when it's sold on account, the other party haven't paid us yet, we put this into account receivable. And at the same time, don't forget to book the COGS, book the cost of the selling activity. We debit COGS and credit inventory. Yeah, that's it. And so the next thing is internal control and cash. And in this part, we will talk about the bank reconciliations. The bank reconciliations ties the cash amount in the company's book to the cash amount in the bank. And the reason that we do bank reconciliation will be, first of all, we are trying to identify the bookkeeping errors. Any of the errors that is made during the process, we can identify because if we are making some errors, they will not reconcile. And secondly, we will seek and resolve the discrepancies. And the third one, this bank reconciliation is also a part of the internal control. So it can contribute to the company's internal control. So how do I perform a bank reconciliation? We're gonna perform both the banks to books and books to bank reconciliation. And both must end up with the same reconciled balance. And it's always recommended to start with the bank's cash balance because in this way it will be easier and more manageable. And adjust for transactions that the banks has not yet recorded to find the reconciled balance. And what do we have to do to make some adjustment is we have to add the deposit in transit, which means some of the deposit are made on a weekend, but the bank was closed, so the bank cannot book this. And this is the thing that we need to add from the bank side. And something we have to subtract is the outstanding check. So it's like when we pay out the check, we will book this on our general ledger, but the banks don't know yet. So it probably will take up to 6 months when the check holder to bring the checks to the banks to cash the check, right? So until that time, the bank will be noticed. So we have to subtract this part. And also, if the bank has made some errors, for example, as arithmetic errors or clerical errors, and then you have to make some adjustment for this part as well. Okay, so the books to bank side, you have to start with the company's cash balance. And the items that we have to adjust is the interest earned in the bank account, which means, when we have some of the interest, the bank will automatically book that, but we will not get to know this until we get the bank letter, probably at the end of the month. So we have to book this in the company side, in the general ledger. And also we have to add the bank collections, which means the customers who pay directly to the bank without noticing us. We don't know this until we get the bank slip or we get the bank letter. And ETF receipts is like cash received by the bank via your behalf on your behalf via ETF. So this is similar with the bank um, collections. And what we have to subtract is the bank charges not yet recorded in books. So for example, some of the service fee, the printed check cost. The bank will book this automatically, but we don't know this yet, so we have to subtract these fees on our general ledger. And also this NSF checks is also called bounced checks. It's like the other people write the checks, but they don't have enough funds in their account, so not sufficient funds, and this check will be bounced back. We thought that we collect the money, but actually not. So we have to reverse the journal entry that we make. We have to make adjusting journal entries. And the ETF payments is similarly like the cash payment via ETF. So this is the part that we have to make adjustment. And this NSF have a more detailed explanation. So NSF is short for non-sufficient funds and refers to bounced checks. And when the company receives the check, it assumes that the customer has paid and increased its cash balance. Normally, it will debit cash or credit account receivable. And when it discovers that the customer check has bounced, the company must reduce its check balance and re-increase its account receivable balance. So the adjusting journal entry will be debiting account receivable or crediting cash. Therefore, to reconcile the cash on the company's book with that of the bank's statement, we must reduce the company's book for the amount of the NSF check. And here's one of the example. So Brad Pitt sells an industrial oven to the Piper for 2000. So for Brad Pitt, when it sells something, you gotta credit sales revenue for 2000 and debit account receivable 2000. And Piper pays Brad Pitt by check, um, starting from the point of Brad Pitt, it will debit cash because um, Brad Pitt think this check is valid, and Brad Pitt got the cash. So debit cash 2000 and credit account receivable to decrease the account receivable. And if the check bounces, Brad Pitt cash balance is always stated by 2000 because they did not receive the payment they sought. So in order to reconcile this, it must decrease its cash balance by 2000 to match that of the bank's statement. So the journal entries for Brad Pitt will be a reverse one. I put it here. It'll be something like this. It's the reverse if you compare to the previous one, right? Okay, so let's move to the next part. Account receivable. So here we have the concept of credit loss and allowance for expected credit losses. right? So first of all, if we estimate some part of the account receivable is not collectible anymore, so we will debit credit loss, and this is actually a kind of expense. So it's a kind of expense that will decrease your revenue and decrease your return earnings in the end. And the other side, we will credit allowance for expected credit loss. And this is the so-called AFECL, AFECL account. And this is simply when we estimate some some portion of the account receivable is not collectible. But when the account receivable really becomes bad, so we will debit allowance for expected credit loss for the part that become bad, and we will credit account receivable. So in this way, account receivable will be decreased, and we are trying to clear out for this part of the um, allowance for expected credit loss. As, please note the difference. And this is when we estimate some part is not collectible. And this is when the account receivable really becomes bad, right? So when you estimate some part is uncollectible, you will not decrease the account receivable directly. You will use the allowance for expected credit loss and the credit losses. And you will put this part into the expense, and you will put the other side into the allowance for expected credit loss. And when it really becomes bad, and you moving this part out of the allowance for expected credit loss, and you decrease the account receivable when it really becomes bad, right? This is the difference. And if the clients repays the bad debt, so previously we have already, think that the account receivable become bad, right? We have this journal entry already. But if the clients repay the bad debt, what we will do, we will debit account receivable and credit allowance for expected credit loss. And you may find that this is the reverse of this journal entry, right? Because this is when the account receivable become bad. We think that we will not collect this month or we will not collect this portion anymore. So we credit account receivable. And when the clients repay it, so what we did previously is actually wrong. So we have to do the reverse one. And we're gonna make this reverse, right? So we have more account receivable. But this client repays us already. So again, we decrease the account receivable and debit cash to show that. So for this account receivable, we collect the cash. So account receivable appears twice here. One times the meaning is we're trying to do a reverse one for the AR become bad. And second one is we get the cash and we decrease the account receivable. So don't get confused here. So account receivable appears twice here, right? And two of the accounts are generally assessed or calculated in this type of question. One is the ending balance for AFECL. Another one is calculating the ending account receivable. So if we calculate the ending AFECL directly, and this is the method that we do it. We use the beginning AFECL and we add the credit loss for the year. And why we do this? Because if we have the credit loss for the year, it means we know how much of the credit allowance for expected credit loss we newly booked. So we add this part and then we subtract the write-offs. We subtract the write-off is like we know that we don't want this part. We are not expecting the um the customer to pay. And the recovers, why we um add back the recoveries is because here, right? So for this amount that is recovered, we will credit allowance for expected credit loss. So we have to add the recoveries here. And then we will have the ending AFECL. And this is how we calculate AFECL directly by using this method. And also, some of the students may get confused about aging analysis, like when we will use the aging analysis. So when we use the aging analysis is also another way to calculate the ending AFECL. Sorry, I cannot do this. So aging analysis also calculating the ending AFECL, right? So in this way, you can calculate the ending AFECL, and in this way, you can also calculate the ending AFECL, right? And let's have a look at the right part and how we calculate the ending account receivable. So this account receivable, and you use the beginning account receivable, there's not much to say about this one, right? And we plus the credit sales, which is very straightforward. You sell something on credit on account, that's the account receivable added. And then you made some collections from your customer, right? So you have to subtract this part, subtract the cash collections, and also subtract the write-offs. Like this part, I don't need this anymore. And for this part, why we add and subtract recoveries twice? It actually goes back. We have to go back. Sorry, we have to go back to the journal entries. So we're gonna go back here, right? That's here we use this account receivable twice. So the first one, we are trying to do a reverse journal entry of this one when the account receivable really become bad. And right now, the clients repay us. So it's the recovery, right? So we use the account receivable, we debit this. Debit means you have to add this. You have to, add this back. And again, if the clients repay the bad debt, it means the clients repay all of that, then we will credit account receivables. And this is why we subtract the recoveries again. So don't get confused here, right? Once you know about the journal entries, you know how to do this calculating thing, and you will not be confused about this, adding and subtracting recoveries. Yeah. So I know this is a bit overwhelming, but let's have a look at the questions altogether. So Walk on Water is the largest wholesaler of pots and pans in Western Canada. Approximately 30% of the company's sales are made on credit. So we highlight this figure. Oh, sorry. Highlight this figure. On credit means not bad cash. It means using account receivable or account payable. And customers have 20 days from the date of sale to remit payment. So the following information is available for the year end December 31, 2024. account receivable growth. This is the beginning balance, right? The first day of 2024. Allowance for expected credit loss, and this is the beginning balance. And total sales. Total sales is the sales that you made for the whole year. And payment on account received from customers. So payment on account received from, so this is the collection of account receivable. And write-offs of account receivable is the amount that you simply wrote off. And this is the recoveries of bad debt during 2024. Recoveries, remember, it's this recoveries and this recoveries. If you are calculating the account receivable, then this actually doesn't matter. But for the AFECL, you have to add this recoveries back. So question A. Oh, sorry. Let's continue reading this. So work on what are provided for expected credit loss using either of the following calculations. So 5% of credit sales of the year. 5% of credit sales of the year. Okay. So expected credit losses. So when we see this expected credit losses, is actually we are calculating this part, credit losses for the year, right? We are doing this one, credit loss for the year. And it is 5% of credit sales for the year. So it means that we can um, directly calculate it out. And let's have a look at the second question. So 10% of current receivables and 25% of non-current receivables, which are overdue at the year end. So this is like similar to the aging analysis. And in this way, we can calculate the year end AFECL. And the first part, we can calculate the expected credit loss directly. Okay, so let's have a look at the question. Determine the December 31, 2024 balance in credit loss and allowance for expected credit loss if the company used the percentage of credit sale method. So we can simply list what we have. Credit sale, sorry. We are using this credit sale method. So credit sales, we have 60% of the company sales are on credit. So we will use this figure, 60%. And total sales, we have the total sales number here. So we will use this. And we time these two together. We have 600, right? And the condition given make it very simple. Like 5% credit sales of the year is the expected credit loss. So we simply times this one with 5%. And then we have the 30,000. Wait, this is the bad debt for a year. And this is bad debt for a year. Let's put it in this way. Okay. And let's use this one. We're gonna use this equation. Even though you don't know what to do, just to put the equation here. Plus is plus for the loss for the year, right? And subtract write-offs. And then add recoveries. Have the ending in FE sale. And let's just trying to plug in the numbers. Opening AFE sale. We have it here, right? So this is 65,000. And this one, credit loss for the year, bad debt expense for the year. So this is what we just calculate. So we put it here. And what is the write-off we have here? We have the write-offs. So I put the figure here. And recoveries. We have the recoveries here. And then we have the ending FECL, which is 30,000. Yeah. So the calculation, we have the ending FECL, which is 30,000. So we are required to do to calculate credit losses and allowance for expected credit loss. So we directly calculate this out, credit losses. So we have credit losses, this one, and we have the FECL balance, the ending FECL balance, which is okay. So it's all 30,000. But 30,000, this 30,000 come from different ways. And this ending AFECL is calculated by this equation. But this credit losses is calculated by doing, first of all, you do the credit sale calculating, and then 5% of the credit sale is the bad debt expense. So in this way, we got these two figures. We got these two figures. Okay, so let's talk about next question. Right, so we're gonna use determine again December 31, 2024 balance of allowance for expected credit losses if the company used aging method. So using aging method, you have to know about the account receivable because the aging method is based on account receivable. So we know that this time we have to use um, this part, right? The right side, this equation. So we calculate, no, we copy the equation here. So the beginning account receivable plus credit sales and subtract collections, right? Cash collections and subtract the write-offs. Remember, subtract the write-offs and plus the uh, recovery and subtract the recovery, right? So we will not calculate. We will simply ignore this. And then we will have the ending account receivable, the ending account receivable. Make it more clean. Okay, so this is the scene that we have. Um, and we are that's the credit office. No, this FECL doesn't necessarily equals to credit losses because credit losses is um, the amount that happens here when you estimate of your uncollectible amount, but this allowance for expected credit loss is always, changing and adjusting. So when some of the account receivable become bad, and it was subtracted, so this part becomes smaller, and if the clients repaid bad debt, this become bigger again. So it could probably the ending balance will be different from the credit losses. Let's get back to the questions. So we have this equation and we are trying to plug in the numbers. Um, account opening balance for account receivable. Here we got a 500,000 and we put it here and credit sales, which is payment account received. Credit sales we calculate already. We used number here and subtract the cash collection, which is you can find it here, payment on account received from customers. This is the amount that we collect. And subtract the write-offs. The write-offs, as I remember, is eight 80,000. And you can find it here, right? The write-offs of account receivable, 80,000. And then you should plus the 50,000 and subtract this is 50,000, but we will not put this here anymore. So we have the ending account receivable, which is that? 8968 triple zero. Um, and it is said that this is the ending account receivable, right? And let's read the question again. 10% of the receivables. Now we have the receivables already. So 10% of the receivables and 25% of non-current receivables, which are overdue as at year end. And 50% of the gross account receivable are current. Current 10%, non-current 25%. So times 50. I hope this is right. Okay. And non-current. Current AR. It's the same value because it's 50 to 50, right? And um 25%, 25% of the non-current receivables are overdue as year-end, and 10% of the current. So we will simply times 10% here, and it means times 10%. We have times 25%, which is 12100. So this is the aging method, right? So current account receivable, non-current account receivable, account receivable. This is how we calculate the current account receivable, and 10% of the current receivable is due at the year end, and 25% is due at the year end for non-current account receivable. So we have to add these two figures together. So total will be uh so just want to remind you that for this aging analysis method, the thing that we calculate is the ending AFECL. It's the ending AFECL value. And for the journal entry, adjusting journal entry, we still have to book the difference, the ending, using this ending AFECL and minus the beginning one. Yeah. So, but we are here, we just need to calculate the balance of allowance for expected credit losses. So it ends up here because this is the ending. Oh, sorry. This is the ending FECL value. But I'm just saying that if we are required to do journal entries, and this is not probably not the amount that we will put into journal entry, because we will put the difference between the beginning balance and the ending balance of the AFECL, so that we are making adjustment, right? So I know this is a bit tricky and a bit confusing. I just wanna you probably could spend more time um, doing the exercise and reading about this question again. Okay, let's move to the next part, inventory, and this inventory will be very important as well. So first of all, we're gonna talk about tangible items. So these tangible items are something that is held for sale by a business, or it's used to produce goods for sale by a business. And inventory is a current assets. It's a current asset, so it's relatively easy to liquidate. As it generally used within 1 year. Right, so it's generally used within 1 year, so it was classified in current assets. And inventory is displayed on financial statements through inventory here, of course, on balance sheet and income statement. What is this? This is COGS. Remember the journal entry? Like every time um we make the revenue, we always have to do the journal entry, right? We debit COGS and we credit inventory. Okay, so that's why COGS on the income statement. Okay, next thing. When we talk about cost of goods sold, so cost of inventory sold by your business is an expense and therefore always debit debited. So it's always debited unless we are making a adjusting journal entry or we are doing the closing entry. So two ways to calculate. First of all is the numbers of goods sold and times the cost per unit, and we have the COGS. Or in another way, we can use the beginning inventory plus the purchased, subtract the ending inventory, and we get the COGS. And the first one is widely used in perpetual inventory method, and second one is used in periodic inventory system. So, first part, inventory costing method. The first one is the specific identification method, which means that each item is individually identified and recorded and is tracked. So primarily used for very expensive, very valuable items. So since it's very valuable and expensive items, we need to be very specific about where it goes and when it was sold. And first in, first out means the earliest goods purchased are the earliest good sold. It is just as what it looks like. And weighted average. And COGS is based on the average cost per unit. So if we are using a weighted average, it means every time we purchase or sell something, we need to recalculate the price. But most likely when we sell something, we are using the existing price, but we probably will purchase something at a different price compared to what we have. So every just remember that every time when we purchase something, you will definitely have to calculate a new price. So we need to make some high level comparison. If the unit costs are rising, FIFO provides the lowest because the unit costs are rising, and FIFO we are using the earliest batch of the goods that we purchased, right? So because we have the lowest cost of goods sold, then we will have the highest net income or gross profit and highest ending inventory. Right? Because the unit costs are rising and we used up the cheapest or the lowest cost ones and the highest cost, the highest priced ones are remained in our inventory. If the costs are declining, FIFO provides the highest cost of goods sold. right? Because the price is declining, and FIFO we use the earliest batch of the items purchased. So we are using the relatively expensive items. So we will have the highest cost of goods sold. And in this way, we will have the lowest net income. We'll have the lowest net income and the lowest ending inventory compared to weighted average cost. Okay, let's have a look at the last question. So the Cold Father is a fish market based out of Seattle, Washington. January 1st, they purchased five pink salmons for $8 each. On January 5th, they purchased an additional five pink salmon for $10 each. On January 10th, they purchased an additional five pink salmon for 15 each. On January 12th, a customer purchased eight pink salmon from the Codfather for 20 each. They choose to fish 5, 6 to 8, and 12 to 15. Okay, we are required to do what is the gross profit? Um, we use revenues to subtract cost of the Godfather and each of the inventory using method. Okay, so I guess this question is trying to ask us to calculate and make a comparison. So we will do it like this. Insert a table. I forgot how to merge the table. Well, anyway, let's just forget about this table. Um, revenues. First of all, let's have a look at the revenues. For a specific ID, a customer purchased eight pinks from the code photo for 20 each. They choose purchased. Also, by reading this, we know that these first three items are all purchasing. And this January 12th is selling. And so this company sold altogether eight fishes, right? So the revenue will be eight fish and times 20, right? So 8 times 20, then we got 160. as the revenue. And the cost. So what is the cost we have? Let's move to the next page. Okay. So because it's a specific ID and the customer, they choose fish 5, 6 to 8, and 12 to 15. So the fish number 5 is here. They purchased the 5 pink salmon for $8 each. So the cost will be $8. And they choose number 6 to 8. So it belongs to here. They purchased the additional 5 pink salmon for $10 each. And 6 to 8 is number 6 to 8. 6 to 8 is 3 times 10, right? Equals to 30. This is the cost. Cost, and this is the cost. And number 12 to 15. How many fishes? It's 4. 4 fishes and times 12, 15 belongs to here, like 15 each. 4 times 15, we got 60. And this is another cost. So in this way, using the specific ID, we know the total cost will be, sum these two together, 98. It will be 98. And then the gross profit will be using the revenue subtract costs, right? Which means this is the gross profit if we are using the specific ID method. Okay, let's have a look at the FIFO. Revenues. Revenues, so the customer purchased the 8 pink salmon, and the revenue will be the same. Right? But the cost will be different. For the cost number 1 to, because it's first in, first out, so we totally, under FIFO method, we sell 8 salmon. And for the first 1 to 5, they purchase the 5 salmon here for $8 each. So the cost will be 5 times 8 equals to 40. And this 40 is the first cost, or the COGS, right? And let's keep doing this. And for the 6 to 8, another 3 fishes. So 3 times $10 each for the second batch. And then we have another 30. So altogether, the total cost will be 70. So the total cost will be 70. And in this way, the gross profit. In this way, the gross profit will be 160 minus 70 equals to 90. You see, this is different from the specific ID. And if we are using the weighted average method, still the revenue will be the same. You have revenues the same. And for the cost, for the fish 1 to 5, with 5 fish and times 8. 8 equals to 40. And for the fish 6 to 10, it's 5 fish again and times 10. 50. And for fish and 5 fish and times 15, we got 75. So this is the 3 times that we purchased the fish with always different prices. So we're gonna come up with a different number for the price. So the total inventory after 3 purchased will be 165. Just the sum all of this together. And the total units. How many units do we have? Total fishes. Sorry. Total fishes we have 15. And then we're gonna come up with a new price. Price per unit. $165 divided by 15, and then we have 11. We have 11. So um so this is the price that we will use to calculate the cost for weighted average method. Um So 11 times how many fish we sold? 8, right? Uh, so our costs for this one will be 88. So the total cost will be 88. And gross profit will be 160 minus 88. We got 72. Yeah. This this step is very important. So you got total inventory and you have the total fishes and you come up with a newly calculated price. So you use the total inventory divided by unit. You have the price per unit, which is 11. And then you use this 11 as the new um, method, and this is new price to calculate the cost when you sell the fishes. Okay, so that's about this question. Okay, so inventory systems. The periodical inventory system is the company physically counts the inventory remaining at the end of the period. But there's something not good is not as up to date, but this is easier and cheaper. And for perpetual one, so inventory record adjusted after each transaction, purchase or sell. And this is more up to date and is used always used by big companies. Um, it's by some automatic softwares. So that's all about today, and I don't have that much general advice to give you. Just hope that you could practice more because we still have some time left before we have the exam. And yeah, so if you cannot think of something else, just stick to the basics rules, like debit equals to credit and assets equals to liability plus shareholders' equity. Um, and yeah, and the various types of financial statement are connected throughout return earnings. And that's all for today. And thank you for everyone. Wish you all have a good result in the midterm exam. And thank you. Will this recording be posted? I think this recording will be posted after this meeting. If you don't have any other questions, I will upload into Canvas, and I think I will send a notice, send a announcement. Yeah. Okay. Thank you. Bye bye, everyone.